Hello everyone, welcome to the Tim Booker channel. I wish you a pleasant time listening to the book. Today, the book I will interpret for you is Mastering the Market Cycle. In investments, people often wish they could predict the future, having everything under control. Just like the changing seasons in our lives, the economy and investment markets also exhibit cyclical fluctuations. If one can comprehend the mysteries within, events may seem like historical repetitions, providing a certain degree of omniscience. The book we're discussing today is a work on investment cycle research. Its author, Howard Marks, is a renowned American professional investor and the author of the bestseller, The Most Important Thing Illuminated. Warren Buffett highly admires him, stating that the first thing he opens and reads in his emails is Howard Marks' memos, as they always offer valuable insights. His books are no exception. In 1995, Howard Marks founded the well-known hedge fund firm Oaktree Capital, managing assets of over $120 billion. Over 22 years, he achieved an average investment performance of 19%, a feat comparable to Warren Buffett's Berkshire Hathaway's average performance of 19% over more than 50 years. Both masters' long-term investment achievements are indeed splendid. In this book, the author combines abundant cases with his own investment experiences to analyze various economic and financial cycles from fundamental, psychological, and market perspectives. He elucidates the characteristics, reasons, and influences of different cycles, delving into the driving factors behind them, such as supply-demand relationships, psychological factors, and policy interventions. The book provides readers with concrete and vivid guidelines for dealing with cycles, helping them better understand and navigate investment opportunities. Ray Dalio, the founder of Bridgewater Associates and the author of the bestseller, Principles, praises this book, calling it a must-read for investors. The discussion of cycles in the book is of great significance. Next, I will divide my interpretation of the main content of this book into three parts. Part 1, What are cycles? Part 2, What are the common types of cycles? Part 3, How should we respond to cycles? Let's start with Part 1, What are cycles? When we talk about cycles, what comes to mind first? Perhaps it's the infinite waveforms with the same amplitude and frequency, repeating over and over again, like the laws of physics. Or maybe it's the four seasons rotating in nature, year after year, endlessly. In these patterns, we observe repetitive and highly regular characteristics. However, in the realms of economy, markets, and human behavior, such strict regularity is impossible. So, what are their cycles like? The author of this book believes that a series of events occurring in a specific order, one after another, and frequently repeating, can be considered a cycle. It doesn't necessarily have to be a simple repetition, cycles can also involve fluctuations around a long-term trend or a central point. This is the fundamental form of cycles discussed in the book. The author finds this definition of cycles quite acceptable. Cycles are a set of events that occur in a certain order, one after the other, with this sequence often repeating. Now, why do cycles occur? The author identifies two main reasons. The first reason is the law of mean reversion. Imagine a pendulum swinging to its highest point. Naturally, it will return to the equilibrium position under the influence of gravity. When cycles deviate extremely from their central point, participants in the cycle often act to bring it back to normal levels. This reversion is a natural law in cyclic movements. For example, in the stock market, when stock prices are either extremely undervalued or overvalued, people typically believe that the market is in an abnormal state. The force of this consensus will pull the stock prices back from their extreme states to normal levels. Of course, this is not the only driving force. Changes in fundamentals and other factors can also influence stock prices to revert to normal levels. For instance, economic overheating leading to bubbles or irrational prosperity resulting in a stock market crash are examples of forces and manifestations of mean reversion. We will explore this issue further later. For now, let's not delve too deeply into it. In summary, the forces and patterns of mean reversion lead to the emergence of cycles, which can also be referred to as the pendulum effect or the middle path. The second reason is human psychology and behavior. As participants in economic activities, human decisions and actions also influence the economy. Human psychological states often change with economic prosperity and recession. During economic booms, people tend to be optimistic and adventurous, willing to consume and invest, further driving economic growth. However, when the economy enters a recession, people become cautious and conservative, reducing consumption and investment, leading to a slowdown in economic activity. This cyclical variation in human psychology and behavior intensifies the fluctuations in the economic cycle. Natural laws and human behavior, these two reasons together, result in the cyclical nature of economic activity. So, what are the characteristics of cycles? The author identifies three main characteristics: causality, mean reversion, and extremity. Let's start with the first characteristic, causality. In cycles, there exists a cause and effect relationship between events. The occurrence of one event may trigger the occurrence of other events, forming a network of mutual influence and interaction. The book provides an example where someone once asked former U.S. Secretary of State, Henry Kissinger, to explain the events in Bosnia from the previous day. Kissinger's response began with, "Let's start from 1722. This shows that historical events are part of a chain reaction rather than isolated incidents. Understanding this characteristic is crucial when analyzing cycles, as tracing events backward enables us to find the driving forces behind the cycle's progression. For instance, when analyzing a financial crisis, we often start from the real estate market's fervor in the pre-crisis period of 2007. However, to observe the entire cycle, we must continue tracing back to 2004 when the Bush administration aimed to enable every American family to own a home and relaxed housing purchase restrictions, creating a surge in demand and driving housing prices up. Looking further back, there were events like the bursting of the dot-com bubble in 2001 and the 9/11 attacks, leading to a recession in the U.S. economy. To stimulate the economy, the Federal Reserve adopted loose monetary policies, providing continuous economic stimuli and planting the seeds for future bubbles. The more you trace back, the deeper and more thorough your understanding of cycles becomes. This is the causality in cycles. The second characteristic is mean reversion. As mentioned earlier regarding the reasons for the occurrence of cycles, various economic indicators and market performance tend not to remain at extreme positions for an extended period. Participants in the cycle often act to push it back towards the center point or long-term trend. This aspect is both a reason for the emergence of cycles and one of their characteristics. The third characteristic is extremity. The fluctuations of cycles are similar to a pendulum swinging, where the energy swinging from the center point to the extreme position also leads to a swing back to the center point. However, the time spent at the center point is much shorter than at the extreme positions. In other words, while cycles do revert to the center point, the time spent in non-equilibrium positions is much longer than the time spent at the equilibrium position. For example, from 1970 to 2016, the author's average annual return on stock market investments was 10%. If we take the average return plus minus 2% as the normal range, i.e., 8% to 12%, there were only 3 out of 47 years within the normal range, a surprisingly small number. In other words, on average, it takes around 16 years to encounter 1 year of normal stock market performance. Alright, the above covers the main content of Part 1. From an overall perspective, we have understood the definition of cycles, the reasons for their occurrence, and the three main characteristics of cycles. Now, let's take a closer look at the types of cycles related to investments. In the book, the author discusses 9 common cycles that are relevant to investments, broadly divided into 3 categories. Cycles related to fundamentals. Economic cycles. Credit cycles. Government countercyclical policies. Corporate profit cycles. Cycles related to psychology. Emotional cycles. Risk attitude cycles. Specific cycles in different investment fields. Non-performing loan cycles. Real estate cycles. Market cycles, specifically referring to stock market cycles. These 9 types of cycles interact with each other and sometimes intersect. I won't go into detail on all of them. Instead, I will focus on 3 cycle types that are closely related to stock investments: credit cycles, psychological cycles, and market cycles. Let's start with credit cycles. The credit cycle refers to the periodic fluctuations in financial institutions' credit activities, representing the availability of funds in the market, including loan thresholds and interest rates. In our daily lives, this relates to activities like home mortgages, car loans, and bank loans that businesses apply for to expand their operations. For example, in a scenario where mortgage rates decrease or banks lower lending standards, borrowers can access more money, indicating an easy credit market. Conversely, if mortgage rates increase or banks tighten lending standards, access to money becomes more limited, indicating a tight credit market. During different stages of the economy, the credit market experiences varying degrees of volatility. In times of prosperity, both corporate profits and personal income prospects look promising, and the risk of loans appears low. Financial institutions believe it's profitable to provide more loans, leading them to lower loan thresholds and interest rates, making the credit market more accommodating. However, during this time, the optimism of financial institutions may lead to overlooking risks. As The Economist magazine put it, the worst loans are made in the best of times. This reflects the situation during this period. But when pessimistic signals emerge, such as initial loan losses, it can impact financial institutions' confidence, causing them to become more cautious and risk-averse. They might take measures like raising interest rates and tightening lending standards, leading to a downturn in the credit cycle. Companies might struggle to get loans, and when existing debts come due, they might not secure refinancing, leading to bond defaults and business bankruptcies, further exacerbating economic contraction. The 2007 subprime crisis is a classic example of this scenario. When the credit cycle reaches an extreme low, it reverses once again, following a similar principle to what was mentioned earlier. I won't elaborate further on this. The author believes that the most important aspect of dealing with the credit cycle is to recognize the situation when the cycle reaches its peak. At this point, everything appears prosperous, investors are adventurous, eager to invest, and borrowers can easily obtain loans with credit markets wide open. However, the more exuberant the situation, the more cautious one should be. When the credit cycle reaches its peak, blindly joining the celebration could lead to heavy losses. For instance, during the dot-com bubble, telecommunication companies easily borrowed money and aggressively built fiber optic networks far beyond the actual demand. Many of these fibers remained unused even a decade later, and the funds invested might never be recovered. However, at the same time, the author believes that during a sudden downturn, when credit is contracting due to panic, it becomes the most opportune time to find undervalued assets. This presents a buying opportunity for high-quality assets at a favorable price. The above covers the main movements of the credit cycle. The credit cycle is closely connected to the economic cycle and psychological cycle. For instance, credit can amplify economic fluctuations, affecting companies significantly. Sometimes, economic indicators may show only slight fluctuations, but the impact on a company's profit or loss can be substantial. The main reason behind this is the use of leverage by companies, which amplifies the influence of sales revenue on profits. For example, let's say you invest $1 million to establish a company. In the first year, the profit is $200,000, and in the second year, it declines to $100,000. If the entire $1 million is your own money, the profit decrease is 50%. However, if you borrowed $500,000 of the initial $1 million with an annual interest of $50,000, then the profit needs to be reduced by the interest of $50,000 each year. Now, the profits for the first and second years become $150,000 and $50,000, respectively. The percentage decline now becomes approximately 67%, exceeding the 50% without borrowing money. This illustrates how leverage can magnify gains and losses, one of the 9 major cycle types mentioned in the book, specifically referring to the corporate profit cycle. Furthermore, we can observe that although corporate profit fluctuations are larger than those of the overall economy, they are still relatively mild compared to the significant ups and downs in the securities market. The author believes that the main reason for this phenomenon lies in investors' psychological fluctuations, leading us to the second important cycle, the psychological cycle. The psychological cycle refers to investors' emotions swinging back and forth, oscillating between greed and fear, optimism and pessimism. The book provides an interesting example, showing that when investors are optimistic, they interpret all news positively. They see reports of strong economic data as a sign of economic improvement and believe that stock prices will rise. Even when presented with reports of weak economic data, they may think that the central bank will introduce loose monetary policies, benefiting the economy and the stock market, leading them to believe that stock prices will still go up. On the other hand, when investors are pessimistic, they interpret all news as a signal for stock prices to decline. The author believes that, in reality, the data and events themselves are not as important as how investors interpret them. The interpretation can change based on investors' psychological state, which creates periodic shifts in risk preferences. When investors are optimistic, they are more likely to be greedy, willing to take high risks, and pursue high returns, often adopting aggressive investment strategies. Conversely, when investors are pessimistic, they are more prone to fear, becoming more cautious, and reducing their risk appetite. This may lead to a decrease in demand for risky investments, and they often adopt conservative investment approaches. This is another of the 9 major cycles mentioned in the book, specifically referring to the risk attitude cycle. The above covers the main aspects of the psychological cycle. Due to the phenomenon known as herding behavior, where most investors tend to follow the actions of others, both changes in investor psychology and risk attitudes result in market sentiment oscillating between greed and fear, trust and doubt. This oscillation makes the market highly susceptible to extremes. The main content of the credit cycle and psychological cycle has been explained. Now, let's conduct a comprehensive analysis to understand the market cycle, which mainly refers to the stock market cycle, and explore how various cycles interact. According to the author, the stock market is mainly influenced by 2 factors, fundamentals and psychology. Fundamentals refer to corporate earnings and cash flows, while psychology is how investors perceive these fundamentals, especially in terms of optimism and risk preferences. In simple terms, the stock market cycle is characterized by fluctuations between optimism and pessimism. Let's focus on the situation at the peak of the stock market cycle, which is particularly crucial to pay attention to during investments. When the stock market cycle reaches its peak, bubbles often form. However, not all significant increases in stock prices are necessarily bubbles. The author believes that when you hear voices saying that even if the prices are high, there's no way you can lose money by buying in, it indicates the proliferation of irrational investment psychology. At this point, you should be cautious and examine if a bubble is emerging. For example, during the 1960s, the market crazily pursued the Nifty 50 stocks, a group of 50 popular growth stocks that were highly regarded by investors at that time. These companies included Xerox, IBM, Kodak, HP, Coca-Cola, and others. They were considered stable and financially strong, leading investors to believe they were immune to problems. The prevailing sentiment was that no matter at what price you bought in, holding on to them would guarantee profits. At this time, investors' buying decisions were driven not by rational analysis but by frenzied emotions and herd mentality. As a result, the Nifty 50 stocks soared, and by 1968, their price-to-earnings, P/E, ratios reached extremely high levels, ranging from 80 to 90 times earnings. A P/E ratio of 80 to 90 times indicates an overvaluation of stocks. However, when investor enthusiasm cooled down, stock prices plummeted. By 1973, some of these stocks were trading at only 1/8 to 1/9 of their previous values, and some even went bankrupt. A similar scenario occurred during the late 1990s with the dot-com bubble. Investors were optimistic about internet-related stocks, and the common belief was that investing in these companies would yield profits regardless of the price paid. Many internet companies had no profits, but investors remained optimistic and invented alternative valuation metrics, such as price-to-sales ratios or website visitor counts, to justify their investments. Both examples illustrate that voices claiming that you won't lose money no matter how high the prices go are signs of a bubble. In the end, these bubbles burst, leading to significant losses for investors. In summary, the market cycle showcases the characteristics of various cycles. Economic fluctuations affect corporate profit cycles, which, in turn, influence investors' optimism, leading to shifts in the psychological cycle and risk preference cycle, making their investments more aggressive. All these factors combine drive asset prices upward or downward. The above covers the main content of the credit cycle, psychological cycle, and market cycle. Additionally, the author believes that individual success and failure also follow cycles. Success itself contains the seeds of failure, and similarly, failure may contain the seeds of success. You may have heard of the magazine cover curse, which refers to sports stars appearing on magazine covers and subsequently experiencing a decline in performance or no longer winning championships. Similarly, entrepreneurs featured on Forbes magazine covers often experience a significant drop in business performance. According to the author, this phenomenon occurs because success often makes people feel intelligent and confident, which is a good thing. However, excessive confidence can lead to problems. Moreover, the fame and fortune that come with success can diminish people's motivation to strive for further achievements, or it may simply be that the previous stroke of luck has run out. On the contrary, the saying, "failure is the mother of success," is more commonly observed. We can learn valuable lessons from failures and lay the groundwork for future success. Understanding these points helps us remain humble and steady, thus achieving long-term success. So, in summary, the second part mainly focused on three types of cycles: the credit cycle, psychological cycle, and market cycle. Additionally, individual success and failure also have their cycles. All the information about cycles has been discussed to better cope with them. Now let's move on to the third part today, discussing how to better cope with cycles. The author believes that the vast majority of people do not possess the ability to foresee the future. Therefore, it is futile to attempt predicting the future. Instead, the key lies in carefully assessing one's current position and making investment decisions accordingly. The author suggests adopting a combination of quantitative and qualitative analysis. Quantitative analysis primarily focuses on market valuation levels, evaluating whether assets are undervalued or overvalued to determine the position in the cycle. For example, the price-to-earnings ratio, P/E ratio, is a commonly used valuation indicator when analyzing stocks. For instance, during the internet bubble, the P/E ratio of the Nifty 50 stocks was as high as 890 times, indicating an extremely overvalued situation. However, relying solely on valuation judgments is not sufficient. Qualitative analysis is also essential, involving observing other investors' behaviors, their buying and selling decisions, and emotional fluctuations to gauge the current cycle position. At extreme points in the cycle, extreme optimism or pessimism prevails. At the market peak, people interpret every event as positive news, and normal levels are overlooked. Anyone expressing concerns or doubts is often ridiculed and labeled as lacking imagination. True investment experts can resist external influences, maintain a rational and objective analysis, acknowledge both positive and negative news, and avoid becoming excessively emotional. With this theoretical knowledge, the author offers practical advice for actual investment. Act when the market reaches extreme conditions, as extreme situations usually have higher volatility and uncertainty but offer a more accurate judgment of the cycle position. Be brave enough to buy during a downtrend. The author metaphorically calls this behavior, catching a falling knife. Abandon the desire to buy at the lowest point, since only after a real rebound can one identify the bottom, which is difficult to predict. Avoid overly focusing on short-term market fluctuations and instead aim to seize the opportunity of a cycle that may occur once or a few times in a lifetime. In summary, the key to coping with cycles is to judge the valuation level and the psychological pendulum of investors, where it swings. When valuation is excessively high and investors are overly optimistic, it is better to stay away from the market and not buy or even sell. When valuation is low, and the market is filled with pessimism, it may be a time to buy. However, this requires the ability to identify quality assets, and only then can a crisis turn into an opportunity. Although the theory of studying cycles is valuable, it does have limitations. First, it helps to determine the probability of events occurring but doesn't guarantee knowing what will precisely happen. Second, even if the cycle position is correctly identified, investing too early or being on the wrong side can be detrimental. For instance, staying cautious during a bubble might lead to underperformance compared to others for several years, making it a significant challenge for investors, even for seasoned experts like Howard Marks. In conclusion, understanding cycles can be useful, but it is not a panacea and has its challenges and limitations, especially when it comes to the timing and precision of investment decisions. Finally, determining the position in the cycle is very challenging. Even the author himself, in over 50 years, has only made 4 or 5 major cycle judgments. Therefore, if you cannot do it, don't feel disappointed. While discovering cycles is difficult, studying them still serves a purpose. We can improve our judgment accuracy by utilizing the extremity of cycles, mainly focusing on extreme signals. For example, during the internet bubble, the excessively high price-to-earnings ratios and extreme optimism of investors were significant signals. Furthermore, once you enter the market, be prepared to take on risks and potential losses. Investing is a delicate balance between offense and defense, a constant game of human nature between adventurousness and conservatism. Cycle analysis can be a method to help adjust our mindset, becoming bolder in times of market slump and more cautious during prosperity, allowing for more reasonable investment decisions. In conclusion, understanding cycles is not about accurately predicting the future but rather gaining a better understanding of the present. When dealing with cycles, we need to change our thinking and avoid fearless speculations about the future. By studying valuations and observing other investors' behaviors, we can better judge our current position. Additionally, when opportunities arise, dare to catch a falling knife and make bold investments. Ultimately, cycle analysis is valuable, but it is not a mystical solution. Judging cycles is very challenging and has its limitations. If you cannot do it, don't be discouraged. Above all, the main content of this book on cycles has been introduced. The market operates in ups and downs and cycles. With this book, I believe you can better grasp the concept of cycles in investments and apply the methods and principles in practice to better seize investment opportunities and reduce risks. Investing is a long-term process that requires us to stay calm, rational, and patient. We must strive to overcome human weaknesses to achieve returns amidst the ups and downs of cycles. Congratulations on completing another book. Thank you all for your support and attention. Please subscribe to the Tim Booker channel, like, and share this valuable knowledge with your friends to combine wisdom and practice, achieve financial goals, and create a better future. Thank you, everyone.